Hello everyone, I hope you are all fine. As you know, we will have our lectures online. So these slides are for Monday and Wednesday lectures. It's about how to evaluate stocks. I will do my best to explain everything in details. I will miss very much your interactions and I hope you understand well. What about learning objectives in these slides? You have to know the basic characteristics of common stock. You have to know how to calculate the value of a stock given a history of dividend payments. And through these slides, we will cover 4 models with some assumptions to evaluate the stocks. You have to know how to calculate the price of preferred stock. And at the end, I will mention another methods for evaluating stocks in real life, but I will only mention the rule, and I think Dr. Nader will cover these methods in details in his lectures. What are the characteristics of common stock? We have 6 characteristics of common stock. So the first characteristic is ownership. Stocks are considered major financing vehicle for corporations. Firm can raise funds by issuing shares to the public. So it's major financing vehicle for corporations. Stock provides holders with an opportunity to share in the future cash flows of the issuer. And this will depend on the net income. So shareholders can take part of this net income, can take all the net income, and can take nothing from the net income. So, of course, this will involve risk. It is an ownership instrument, not debt instruments. So shareholders will differ from creditors, which means that holders have ownership in the company. Claim on assets and cash flow. It is the second characteristics, or what we call residual claim. In case of liquidation, في حالة التصفية, shareholders have a claim on the residual assets and cash flow of the company, known as residual rights. But remember that they are last in priority in liquidation. So equity ownership involves risk. Why? Because shareholders are last in priority in liquidation. The firm or the company has to pay first the creditors, then preferred stock, then common stock at the end. So this will involve risk. The third characteristic is voting, voice in management. The standard voting rights will give shareholder 1 vote per share to vote in board elections and other key changes. So every shareholder will have 1 vote per share. But this can be altered by using several classes of stock. What are they? They are non-voting stock and super voting rights. As for non-voting stock, it's usually for a temporary period of time, and according to it, the chair will give no voting right to the shareholder. So every chair in non-voting stock will give the shareholder no voting right. And it is for a temporary period of time, not for a long period of time. And what about super voting rights? They will provide holders with multiple votes per share. So shareholders with super voting rights will have multiple votes for 1 share. For every share, he will have multiple votes. Why? Maybe because he wants to increase his influence and control over the company. So that's why he will buy super voting rights. So in voting, which is the third characteristics of common stock, you have standard voting rights, 1 vote per share. You have non-voting stock, no vote for any share. Super voting rights, the 1 share will give you multiple votes. The fourth characteristic is related to maturity date. In real life, stocks are considered to be permanent financing. They have infinite life, no maturity date, no promised date when investment is returned. This is in real life, but actually in our models, which are theoretical models, you will find that in two models you will have maturity date. This will be covered in the next slides. The fifth characteristics are dividends and their tax effect. Companies pay cash dividends periodically to their shareholders out of net income, usually 4 times per year. Unlike coupon interest paid on bonds, dividends cannot be treated as a tax-deductible expense by the company. So, if you are talking about coupon interest paid on bonds, they are considered an expense for the company. So, no taxes will be imposed on this interest paid. But for the recipient, dividends are considered to be taxable income. Thus, taxes will be imposed on dividends. The last characteristic is primitive right. It is a privilege that allows current shareholders to buy a fixed percentage of all future issues before they are offered to the general public. What does this mean? If, for example, a company that issued 1,000 shares in a primary market, and investor A bought 10% of these 1,000 shares. So he bought 100 shares from this company, which is company Z. After several years, the company issued another 1,000 shares. According to this right, the company will offer investor A to buy a fixed percentage of all future issues, which are 1,000 shares, before they are offered to the general public. So investor A can buy 10% again, which is 100 shares from 1,000 shares. Why? This will make him maintain his proportional ownership in the company. And so he can maintain his power in the company. So what's about stock markets? Stocks are traded in two types of markets, the primary market and the secondary market. The primary market for the first sale and the secondary market for after sale. We will begin stock valuation. Stock valuation. The value of stock is the present value of its expected future cash flow, which includes cash dividends paid and future selling price of the stock if an investor sells it in the secondary market. So it consists of cash dividends and future selling price. You have to get the present value of future selling price and the present value of cash dividends. So in stock valuation, we will have 4 variations of a dividend pricing model. We will have 4 theoretical models to value stock. The first one is the constant dividend model with an infinite horizon. In this model, you will have constant dividend, fixed dividend, with no maturity date, infinite horizon. The second one is the constant dividend model with a finite horizon. We have constant dividend, fixed dividend, but with maturity date. The third one is the constant gross dividend model with an infinite horizon. So here the dividend is not constant, it's growing with a constant growth rate, but no maturity date, infinite. The fourth one is a constant gross dividend model with finite horizon. You have dividend not constant, it is growing with a constant growth rate, and you have maturity date. But these models make different assumptions about the dividend stream. Is it constant or growing? It's constant in the first and the second model. So the first and the second model, you will see that the dividend is constant, is fixed number. Why is growing in the third and fourth model? The third and the fourth model, you will have constant gross dividend. It's not constant, it's not fixed. The second one is the maturity of the stock. Is it held forever or up to a point at which it is needed? So the stock is held forever, or you have maturity date and it's held up to a point. It's held forever in model 1, the constant dividend model with an infinite horizon, and the third one, the constant gross dividend model with an infinite horizon. And it's held up to a point, which means the stock has maturity date in the second model, the constant dividend model with finite horizon, and the fourth model, the constant gross dividend model with a finite horizon. So the first model will be the constant dividend model with an infinite horizon. From the title, you will have fixed dividend and no maturity date. In the constant dividend model with an infinite horizon, you will assume that the firm is paying the same dividend amount in perpetuity. Dividend 1 equal dividend 2 equal dividend 3, and so on till dividend infinity. So here you have constant dividend and no maturity date. And this can remind you of perpetuity or counsel bond in time value money chapter. What is the rule of counsel bond or perpetuity in time value? The rule is present value equal periodical cash flow PMT divided by R. So the present value equal to PMT divided by R, and R is the required rate of return, and PMT is the cash flow. So for stock, to get the present value of it, given you have constant dividend and you have no maturity date, you have to apply the rule price equal dividend divided by required rate of return. So you can conclude that the rule of the first model, which is a constant dividend model with an infinite horizon, is the same rule you apply in perpetuity calculations and counsel bond in chapter time value of money. What is required rate of return? It is the expected rate of return that investors require in order to be willing to invest in the stock. This rate is also called the risk-adjusted discounted rate or market capitalization rate. So we can say that required rate of return is the discounted rate. We will apply the rule of the first model in a problem. Let's say that the grass company is paying a quarterly dividend of $0.5 and has decided to pay the same amount forever. If Joe wants to earn an annual rate of return of 12% on this investment, how much should he offer to buy the stock at? So please read every information given in this problem very carefully to decide which model to apply or which rule to apply. The first information that you have dividend equal to 0.5. You have to ask yourself, is this dividend constant or growing? As you see in this problem, the dividend is constant. You are not given any information that this dividend is growing with constant growth rate. So it's constant. Another question. Is there any maturity date or it's infinite? As you see, the company decided to pay the same amount forever. So it's infinite, no maturity date. Then you have to solve the problem. Given this information, constant dividend, no maturity date, then we are talking about the first model. So you have to apply the first rule, which is dividend divided by rate of return. What is dividend? It's 0.5. What's rate of return? It's 12. But because I'm talking about quarterly dividend, I have to divide 12% by 4. So 12% divided by 4 equals 3%. Then the present value of the stock will be 0.5 divided by 0.03, and the price will be equal to 16.67. So again, here we apply the rule of the first model, which is dividend divided by rate of return, and this rule is the same rule as perpetuity and cancel bond in time value of money. Just to remember. The second model is the constant dividend model with a finite horizon. From the title, you have constant fixed dividend, no gross rate. But you have maturity date. It's not infinite one. Assume that the stock is held for a finite period of time and then sold to another investor. Assume that constant dividends are received over the investment horizon. Price is estimated as the sum of the present value of annuity and of a single sum. This can remind you of what? Of pricing coupon bond. You have maturity date and you have constant dividend received over period of time. So to get the price or the present value in this model, you have to apply the same rule you apply in getting the price of coupon bond. What is the rule? You have to get the present value of the future price. In case of the bond, we get the present value of lump sum, the principal, and you have to get the present value of dividend stream. Also, in the case of bond, we get the present value of coupon payment. So here, to get the price, you have to get the summation of present value of future price and present value of dividend stream. And the rule will be the same rule as the rule of pricing coupon bond. So to get the present value, the price, in the case of constant dividend model with a finite horizon, you have to get the present value of future price and the present value of dividend stream. So present value equal future price divided by 1 plus r to the power n. What is this? It is the present value of the future price. Future price is a lump sum. So to get the present value of the lump sum, you will divide future price divided by 1 plus r to the power n. Then you have to get the present value of dividend stream, of annuity. What is the present value of annuity? Equal BMT, which is dividend, times 1 divided by r, minus 1 divided by r times 1 plus r to the power n. So here you apply the same rule as the rule of pricing the coupon bond. We can apply the rule In another problem, here, client wants to purchase common stock of new company and hold it for 4 years. The directors of the company just announced that they expect to pay an annual cash dividend of $4 per share for at least the next 4 years. Client believes that he will be able to sell the stock for $40 at the end of 4 years. In order to earn 12% on this investment, how much should client pay for this stock? Again, you have to read carefully the information given in any problem related to stock to decide which model you will apply. So read carefully. Here you have $4 per share, which is the dividend. Is it constant? Yes, it's constant. You are not given any growth rate, so it's constant. Do you have maturity date? Yes, you have maturity date. You have 4 years. And you have the selling price, which is the future price, equal to $40. Then you have to apply the rule of the second model, which is the constant dividend model with finite horizon, which is the same as the rule of pricing coupon bond. How to apply it? You have to get the present value of future value, which is a future price, which is 40. How to get the present value? You have to divide 40, which is the future price, divided by 1 plus 0.12, which is the rate of return, all to the power 4. This is the present value of future price. Then you have to get the present value of annuity, which is the dividend, which is constant. The present value of annuity or dividend equal to 4, as given in your problem, times 1 divided by 0.12 minus 1 divided by 0.12 times 1 plus 0.12 to the power 4. And the result will be 37.57. So the price will be 37.57 given the information that you have constant dividend, you have future selling price, and you have maturity date equal to 4 and rate of return equal to 12%. Another example, let's say that the Grass company is paying an annual dividend of $2 and has decided to pay the same amount forever. Joe wants to earn an annual rate of return of 12% on this investment and plans to hold the stock for 5 years with the expectation of selling it for $20 at the end of 5 years. How much should he offer for the stock? Again, you have to read the problem very carefully. The first thing, you have $2 as a dividend. Is it constant? Yes, it's constant, no growth rate. According to the company, this dividend is forever, but take care. The investor, Joe, plans to hold the stock for 5 years. So Joe plans to hold the stock for 5 years. So according to Joe, the investor, he will hold the stock for 5 years, maturity date, and then he will sell the stock. And he expects that the future price will be $20 at the end of 5 years. So, to decide which rule to apply, you have to apply the second rule. Why? Because according to the investor, he will not hold this stock forever, but he will hold it only for 5 years and then we go to the secondary market again and sell it. So we can apply the second rule, which is constant dividend model with a finite horizon. We have dividend 2, we have future price $20, we have N equal to 5, we have R equal to 12%. And you have to get the summation of present value of future price and present value of annuity, which is dividend, which is 2. So applying the rule, the present value will be equal to the present value of the future price, which is future price divided by 1 plus r to the power n, plus the present value of annuity of dividend, which is dividend times 1 divided by r minus 1 divided by r times 1 plus r to the power n. And the result will be 18.56. So here you apply the second rule, which is the same rule as the rule of pricing the coupon bond. The third model is the constant gross dividend model with an infinite horizon. So here we are talking about gross dividend. It's not constant dividend, but the growth rate is constant. That's why it's the constant gross dividend. The dividend is growing, but with constant compound growth rate. Do we have maturity? No, in this model, we do not have any maturity date. So according to the constant gross dividend model with an infinite horizon, you can see that the dividends grow with constant growth rate equal to G, which means that the dividends are not constant, but they are growing with constant compound growth rate equal to G. What's constant? It is the growth rate. So we can say that growth rate may be 5%, maybe 10%, so it's constant number. But dividends are growing with constant growth rate. So we can say that dividend 1 is not equal to dividend 2, is not equal to dividend 3, and so on till dividend infinity. This is far from reality. Why? Because in reality, we can see that growth rate, it's not constant number, but maybe 5 this year, maybe 6, 7, 9, and so on. It's not constant number. But these models, the 4 models, are theoretical base for more sophisticated models. Maybe these sophisticated models, Dr. Nader will cover it. What about dividend note? Dividend note is the most recent dividend, which has already paid, and it is known with certainty. So dividend note is the most recent dividend the company has paid to the investor, and it is known to everyone. Dividend 1 is equal to dividend note times 1 plus G. G is the growth rate of dividend, and dividend 1 is the first cash flow a new purchaser of stock expects to have. What does this mean? This means that dividend 1 is growing with constant growth rate as compared to dividend note. And for example, if you have 2 investors, investor A and investor B, and investor A decides to sell his stock to investor B, the last dividend that investor A will have from the company will be dividend note. And the first dividend that investor B will have from the company will be dividend 1. I hope you understand this. Dividend 2 is equal to dividend note times 1 plus G to the power 2. This can remind you by the compound interest rate in time value of money. So here the growth rate is a compound growth rate, not simple growth rate. So again, dividend 2 equal to dividend note times 1 plus G to the power 2. Also dividend 2 is equal to dividend 1 times 1 plus G, the same meaning. So dividend 2 equal dividend 1 times 1 plus G. And dividend 2 is the second cash flow a new purchaser of stock expects to have. So dividend 2 is the second cash flow a new purchaser of stock expects to have. It's the second dividend he will have if he buys the stock from investor A, as in our example. We can generalize this rule. We can say that dividend T will be equal to dividend note times 1 plus G to the power T. So anytime, for example, dividend 9 will be equal to dividend note 1 plus G to the power 9, and so on. In any time T, you expect that dividend T will be equal to dividend note times 1 plus G to the power T. This general rule, we will use it in the fourth model, so take care. This general rule, we will use it in the fourth model, which is the last model of common stock. So please take care that we will use it again. Then, finally, the dividends grow with compound growth rate, as you see from this slide. This model, the constant growth model with an infinite horizon, is known as Gordon model. Estimate is based on discounted value of an infinite stream of future dividends that grow at a constant rate g. So the price note, the present value, equal to dividend note times 1 plus g divided by 1 plus r plus dividend note 1 plus g to the power 2 divided by 1 plus r to the power 2 and so on till infinity, where r is the required rate of return. But with some algebra, we can simplify the previous rule to price note equal dividend note times 1 plus g divided by r minus g. So that is the rule for the third model. So the rule for the third model will be equal, the price note will be equal to dividend note times 1 plus g divided by r minus g. Or we can say that price note will be equal to dividend 1 divided by rg. Why? Because dividend 1 equal to dividend note times 1 plus g. So we can say dividend note times 1 plus g divided by r minus g, or dividend 1 divided by r minus g. Take care, when you say dividend note, you have to multiply 1 plus g, dividend 1 without multiplication. Also, with some algebra, you can get r from the rule of price note dividend 1 equal r minus g, and the r will be equal to dividend 1 divided by b note plus g. So r will be equal to dividend 1 divided by p note plus g. We can also get general rule, and this rule will be applied on the first model. It's very important in the fourth model. This rule is pt equal to d t plus 1 divided by r minus g. So the price or the future price for stock, for example, in year 7, so we have P7 will be equal to dividend 7 plus 1, which is dividend 8, divided by r minus g, and so on. So general rule, price t equal d t plus 1 divided by r minus g. And again, this rule will be used in the fourth model, the last model. An example for the third model. Let's say that company just paid its shareholders an annual dividend of $2 and has announced that the dividends will grow at an annual rate of 8% forever. If investors expect to earn an annual rate of return of 12% on this investment, how much will they offer for the stock? Given all this information, you have annual dividend equal to $2. You have to ask yourself, is it constant or not? It's not constant. Why? The dividends will grow at annual rate of 8%. So here the dividends will grow. It's not constant. With constant growth rate, which is 8%. Do you have maturity date? No, you don't have any maturity date. The dividends will grow forever. And you have R equal to 12. Then we are talking about the third model, the constant growth model with an infinite horizon. So you have to apply the rule of the third model. So given the information dividend note equal 2, G equal 8%, R equal 12, we can get the price of the third model, the price of stock for the third model. The first step, you have to get dividend 1, which is equal to dividend note times 1 plus G. Dividend note equal 2 and G equal 8, so you have to multiply 2 times 1 plus 0.08. So multiplying 2 times 1.08 will give you 2.16, which is dividend 1. So dividend 1 will be equal to 2.16. Then you have to apply the rule, which is dividend 1 divided by r minus g. Dividend 1, as you have calculated it, equal to 2.16, and r equal 12, g equal 8%. So B note or present value equal 2.16 divided by 0.12 minus 0.08. And the answer will be $54. So the price or the present value of stock given all this information is $54. The last model is the constant gross dividend model with a finite horizon. So here, from the title of this model, you have dividend with gross rate constant. So the dividend is not constant, but it is growing with a constant gross rate. And you have maturity date. So in the model, the constant gross dividend model with a finite horizon, the investor expects to hold stock for a limited number of years, for several years, for specific years. So there is a maturity date. Investor will hold the stock for specific years, and then he will sell the stock. So the investor expects to hold stock for specific number of years. And companies' dividends are growing at constant rate. So here we have maturity date, and we have dividends not constant, but they are growing with compound growth rate, which is constant. So we have again maturity date. The investor will sell the stock after specific years, and the dividends are not constant, but they are growing with a constant compound growth rate. What is the formula? It's more sophisticated, and it's long formula, but I'm sure you can memorize it. It's equal to price note equal to, we will divide it to 3 parts to simplify as possible. The first part is dividend note times 1 plus g divided by r minus g. So this part, the first part, is the same as, it is the same as the rule of third model. Yes. So this part, the first part, is the same as the rule of the third model. Times, take care, it's times 1 minus 1 plus g divided by 1 plus r to the power n. So it's times 1 minus bracket 1 plus g divided by 1 plus r all to the power n. And then plus, take care, plus the third part, price n divided by 1 plus r to the power n. Also this formula, which is price n, the third part, divided 1 plus r to the power n, is a part of the rule of the second model, which is the future price. The future price divided by 1 plus r to the power n. How to get the present value of the future price in the second model, of the common stock. This is the same as this part in the second model. So here we have part from the third model, part from the second model, and a new part. So to remember, the first part is a part of the third model times new part, which is 1 minus 1 plus g 1 plus r all to the power n, plus a part from the second model, which is price n divided by 1 plus r to the power n. Here price n is the future selling price at the year n, and n is the number of years that an investor will hold the stock. Take care here that the price n, as we will see in our problem, you will get it, you have to calculate it. It's not given. Price n, it's not given as in model 2. You will have to calculate it, and I will show you how to calculate it, inshallah, now. So price n, you will have to calculate it, not as in the second model it is given. Okay, let's apply the rule of the forced model in a problem. The company just paid a dividend of $1.25, and analysts expect that dividend to grow at its compound average growth rate of 10.72% forever. If you plan on holding the stock for just 7 years and you have an expected rate of return of 14%, how much would you pay for the stock? Let's analyze the information given in this problem. You have a dividend, 1.25. Is it constant? No, it is not constant, as G, which is compound average growth rate, equal to 10.72. Then it's a constant gross dividend model. You have maturity, 7 years, and you have R equal to 13%. The word forever doesn't mean that we are in infinite horizon. Why? Because as investor, you plan to hold the stock for just 7 years. So there is a maturity date. So it is a finite horizon. Then we are talking about the constant gross dividend model with a finite horizon. So to solve the problem, we have to apply the long formula. And as I said before, we can divide this formula into 3 parts. The first one will be the rule of the third model, which is equal to dividend note times 1 plus G divided by R minus G. And all these are given in our problem. Dividend note equal to 1.25, G equal 10.72, R equal 14. So dividend note equal 1.25 times 1.1072 divided by 0.14 minus 0.1072. This is the first part. The second part is also given. 1 minus 1 plus G, which is 10.72, divided by 1 plus R, all to the power 7. So 1 minus 1.1072 divided by 1.14, all to the power 7, as n is given 7 in our problem. The last part of the formula, which is price n divided by 1 plus R to the power n. Please concentrate. You will depend on 2 rules from the third model to get price n. The first one, you have to apply the general rule, which is price T equal dividend T plus 1 divided by R minus G. In our example, or in our problem, price T, the T is 7. So price 7 will be equal dividend 7 plus 1. Price 7 will be equal dividend 7 plus 1, which is dividend 8, divided by R minus G. Again, the last part is price n divided by 1 plus R to the power n. N in our problem is equal to 7. You have to use the rule, the general rule, in the third model, which is equal to price T equal dividend T plus 1 divided by R minus G. Price T here equal to 7. So price 7 will be equal to dividend 7 plus 1, which is equal to dividend 8 divided by R minus G. The question here, do you have dividend 8? No. You have to calculate dividend 8. How to calculate dividend 8? You will depend on the rule. Dividend 8 equal dividend note times 1 plus G to the power 8. The rule, dividend T equal dividend note times 1 plus G to the power T. So here dividend 8 will be equal to dividend note 1 plus G to the power 8. Again, to get dividend 8, you will apply the rule dividend t equal dividend note times 1 plus g to the power t. This rule is mentioned in the third model. So dividend 8 will be equal to 1.25, which is dividend note, times 1.1072 all to the power 8. And this will be equal to 2.82305. So dividend 8 will be equal to dividend note times 1 plus g to the power 8, which is equal to 1.25 times 1.1072 to the power 8 will be equal to 2.8. So you get dividend 8. And then you return back to apply the rule price t equal dividend t plus 1 equal r minus g. So price 7 will be equal dividend 8 divided by r minus g. So price 7 will be equal 2.82 divided by 0.14 minus 0.1072. Calculated, you will find that price 7 equal to 86.07. So price 7, which is price n in our formula, is equal to 86.07. Please take care that you calculate price 7, but not the third part of the formula. Again, you calculate price 7, but not the third part of the formula. You have to take 86.07 and you have to put it in the last part of the formula, which is 86.07 divided by 1 plus r to the power n. So 86.07 divided by 1.14 all to the power 7. And then you have to calculate all these numbers, and at the end you will get the price will be equal 42.19. The price will be equal 42.19. Second, you have to calculate the present value of preferred stock. Preferred stock. It pays constant dividend as long as the stock is outstanding. To remind you, it's hybrid of debt and equity. It's like debt or bond, as it gives you fixed payment. And it gives you ownership right, so it's like common stock. It has infinite maturity, but some are convertible into common stock. So some of the preferred stock can be converted into common stock. It has preferred status over common stockholders in the case of dividend payments and liquidation payouts. So in case of liquidations, creditors will be the first, then preferred stockholders, then at the end will be common stockholders. How to get the present value of preferred stock? What is the rule? From this information, you can expect that the rule will be the same as that of perpetuity or constant bond, and also will be the same as the first model in the common stock. So you have new maturity date and you have constant payment or fixed payment, which is dividend. To get the price of preferred stock, you have to apply the rule price note equal PMT divided by R. So price note will be equal to annual dividend, which is equal to dividend rate times bar value, and R is the required rate of return. given this example, the company preferred stock pays an annual dividend of 8% per year on its par value, which is equal to $60. If you want to earn 10% on your investment, how much should you offer for this preferred stock? Given the information in this problem, you can solve using the rule B naught equal BMT divided by R. The information is you have 8% annual dividend, which is the dividend rate. You have par value equal to $60. So to get the annual dividend, you have to multiply 8% with $60. So 0.08 times 60 will be equal to 4.8. And this 4.8 is the annual dividend for this preferred stock. Then you have to divide this annual dividend with the rate of return, which is equal to 10% or 0.1. So 4.8 divided by 0.1 will be equal to $48. So the price of preferred stock will be equal to $48. This is the same rule again as the rule of perpetuity and cancel bond in chapter of time value of money, and as the rule of the first model in the common stock valuation. Third, stock valuation in stock market. As I mentioned in the beginning of our slides, that I refer to models in real life, only rules. Our models for common stock, for evaluating common stocks, are theoretical models, as I have said, but they are considered base for real life models. So you will take with me only rules for these real life models. Third, as I mentioned at the beginning of these slides, I will talk about the rules of several methods for stock valuation in real life. Only rule. And I think Dr. Nader will cover these rules in details. The first one is the price earning ratio. It is equal to market price divided by earning per share. What is earning per share? It's net income divided by number of common shares outstanding. Earning per share is covered in financial statement chapter. So price earning ratio will be equal to market price divided by earning per share. And earning per share equal net income divided by number of common shares. And this is covered in financial statement chapter. The second method in real life is net asset value. Net asset value equal to total asset evaluated at market price minus total liabilities. So it's equal to total assets evaluated at market price minus total liabilities. In this method, the total assets are reevaluated by reevaluating lands using market price. Just to remind you, in financial statement, we evaluate land by using historical price, not market price. By using this method in stock valuation, you will again reevaluate land, but at market price, not historical price. So net asset value will be equal to total assets evaluated at market price minus total liabilities. And the total assets are reevaluated again using market price, not historical price. Again, we have another method, which is price to book ratio. And this can be evaluated by dividing the market price by its book value. You can divide the market price by its book value. What is the book value? It's equal to total assets minus total liabilities divided by number of common shares. So the book value equal total assets minus total liabilities divided by number of common shares. Total assets minus total liabilities equal, yes, it's equal to shareholders' equity, as we mentioned in financial statement chapter. total assets equal total liabilities plus shareholders' equity. So total assets minus total liabilities will be equal to shareholders' equity. So the rule can be the share book value equal total assets minus total liabilities divided by number of common shares, or equal shareholders' equity divided by number of common shares. Fourth is capital asset pricing model, which is CAPM. And I will cover, inshallah, this model next lectures in risk and return chapter. So this is the end of our lectures. I hope everything is clear. Wishing you best of luck and thank you.